All right, so my next guest says that the debate over the September rate cut, it was always a distraction, that there are much larger issues out there. So I want to bring in now Wellington-Altus Private Wealth Chief Market Strategist, Jim Thorne. Jim, you talk about the real Fed debate, the fundamental structure of the Fed, the mission creep, the accountability. Did you hear anything today that addressed any of this?
No, not really. I think the genie's out of the bottle. Fed Powell, or Chair Powell, has overplayed his hand. And I think over the next couple of years, we're going to try to figure out what does this Fed look like in terms of this new economy that President Trump is building right now. So I think we're at the beginning of a structural change in the Fed, and I would expect the Fed to look a lot like what they did pre-1951, and I would not be surprised if they become subordinate to the Treasury.
Wow, that's a huge, huge statement, and I think a lot of people hope it comes true. Meanwhile, Jay Powell, he made sort of, if you remember, that sort of odd and very aggressive push back against the Trump in the White House and that now infamous Chicago speech. Did he undo some of that this morning?
I think for consensus, yes, but I think for the folks that have been really following this narrative for a long time, I think it's about time that the Fed feet get put to the fire and they actually follow what's in the Humphrey-Hawkins Act, which they haven't. There has been mission creep. I think Secretary Bessent has amplified that and focused on that. I don't think anything that we are saying right now is missing on the Secretary of the Treasury. And so what I would suggest is that the Fed and their governors are basically a little bit too late in terms of trying to steer the ship back on course. I think the proof is in the pudding. They've crossed the Rubicon, and the Fed will not look the way it has for the last 2 decades.
All right, so, and listen, you've been real spot on there. I want to kind of shift gears here a little bit, talk about the market reaction. And I got to tell you, you've been coming on this show for a while now. Almost everything that you love is working out pretty good today. This new shift, at least, has hit your names really positively. So let's talk about that, because you like innovation, digital assets, housing, home builders, small caps, regional banks, consumer discretionary, and retail. You've talked about this for a long, long time. How do they benefit from a more accommodative Fed?
Well, first, I think that there's going to be liquidity, and people realize that, the market is going to go higher and there's risk assets. And then, Charles, and I think you've been talking about this for a period of time, is Wall Street sold the bottom. Wall Street is underexposed. And so like in 09 or 03, we're going to have a massive catch-up trade between now and the first quarter of 2026. And so, yes, AI is great, but at the same point in time, small cap, retail, home builders, everything is going to have a massive catch-up trade. And so what I would be suggesting your listeners to do, or your viewers to do, is expect the breadth in the market to increase over the next 4 to 6 months.
I got to also, before I let you go, you have been pounding the table on NVIDIA for a long, long, long time. This NVIDIA number next week probably can move the market as much as it's moved today, one way or the other. Talk to us about what you anticipate next week when they report.
Demand is going to be strong. The thesis is intact, and you can buy the leader in AI for a peg less than 1. Don't overthink this. Have a core position. Hold it for the long run.
All right.
It's that simple.
It's just that simple. All right, you got 15 more seconds. Who are you thinking the next Fed chair?
Charles Payne.
All right. You're invited back anytime, Jim. Thanks a lot. We'll see you soon. I always love your expertise. Really. Thank you very much. Good stuff.
Thank you.